It's moving slowly, but it's moving. Success.
Great.
Okay. And now we're going to broadcast and open to our Zoom attendees.
All right.
Okay, well, we're going to get started because it's just a couple minutes after 6:30. Welcome, everyone. I would like to introduce myself. My name is Patty Smolin. I am the Business Liaison Librarian at the Schaumburg Township District Library, and I'm so pleased that you registered for tonight's session. We're broadcasting the session on the library's YouTube channel, and this will widen our audience, and it will be made available for the next few weeks. So if you would like to see a recording of tonight's session, along with the slide content, you're welcome to access the library's YouTube channel for tonight's presentation, as well as others that we have available. I did send out an 8-page handout earlier this afternoon to all of you, and I hope that you did receive it. If for any reason that did not come to you, if you would like to go into the chat feature, I have entered my name and my email address along with the library hours, and you are most welcome to get in touch with me regarding that issue or anything else that I can help you with from the library. I do want to introduce tonight's presenter, Karen Chan. We are welcoming Karen back to the library virtual platform. Karen has been a longstanding presenter with our library, many other public libraries, and other organizations for a number of years. She's also very active with the Money Smart program that we partner with the Federal Reserve Bank of Chicago. Karen has been educating the public about financial topics for 25 years, first as a consumer economics educator with University of Illinois Extension, and for the past 5 years through her own business, Karen Chan Financial Education and Consulting, and LLC. So a brief summary on tonight's topic. We wanted to do this presentation for what women need to know about Social Security, because we thought it would really hit the mark with tonight's audience. Women rely more on Social Security for their income during retirement than men do. That means that maximizing your Social Security benefit is critical. Karen will share which claiming strategies are recommended and which decisions could cost you. Learn how divorce, remarriage, and widowhood affect your benefits. She will also cover special rules about continuing to work while receiving benefits and how a government pension could reduce your Social Security check. I do want to make mention that you have two options to submit questions or comments: the chat feature below, as well as the Q&A. You are most welcome to submit in either of those. Kieran will address questions at the end, unless your question is meant to further explain a topic that she's currently going through. But please be assured that I will be checking questions on the YouTube channel and also your questions, and we will be fielding those at the end of tonight's session. The session should run for about an hour, depending, possibly a little longer, with content and questions. So with that being said, again, Kieran, thank you so very much for making time for our library, and welcome back.
Thank you. Thank you. It's great to be here. It's always a pleasure to be with a library where you know the people, and I'm sure if we had a live audience, I would be recognizing some of you as well. So let me get my screen share started here. You should be seeing my first slide at this point. Are you?
Yes, very clearly.
All right. All right. So Patty gave me a lovely introduction, so we will skip this and go straight to my little housekeeping slide here before we get into the gist of tonight. I want you to remember that tonight is education, and it really is not intended as individual advice. To me, the difference is that you'll say, I learned this, and I need to make a decision about how that applies to me or what action I will take based on that information. But the thing about Social Security is there are many, many rules. They can be complex and they can change. And so I encourage you to use the Social Security website, which is ssa.gov. I'll be probably posting, as we go through the slides, there'll be some that refer you to specific things there. You can request a phone appointment with them. Usually you could get a face-to-face appointment. I will tell you that I have not investigated whether they have resumed face-to-face appointments or not, but obviously those were canceled at the beginning of the coronavirus epidemic. But remember, when you talk to Social Security, they will give you facts. They will not give you advice about the best strategy for you. And so just remember, rely on them for information, but do not rely on them for guidance about what is the best thing for you to do. Why a program just for women? I mean, Social Security treats men and women the same. They do not have different rules based on gender. But as Patty said in the introduction, compared to men, women are more reliant on Social Security because we tend to have fewer assets at retirement than men do. We tend to live longer, which means we have a greater risk of outliving our assets, even if we did have as many assets as men do. We will typically receive a smaller Social Security benefit than men because we have a lower income across the board. And we also typically receive less non-Social Security income. Like I said, all rolled together, that means we're simply more dependent on Social Security for our financial security in retirement. For many women, what that means is that we're more likely to claim early. However, we're going to talk tonight about how that reduces your benefit and give you information that may help you to consider your options when that comes. Because of all this, I think that educating women about Social Security is critical. So that's what we're going to work on tonight. The value of Social Security benefits is nothing to sneeze at. As of January of this year, the average monthly benefit was $1,500. That works out to a lifetime value of $360,000. If that was an asset in your hand, you would consider that well worth managing well. If you are a higher earner or your spouse was a higher earner, maximum benefits for someone retiring this year would be monthly as high as $3,000, making the lifetime value almost $725,000. Now, these are assumptions. These are based on assumptions of living to age 86, which is the average life expectancy for a white female who is age 65 today. Now, other groups have different life expectancies, but I use these numbers just to give you an idea of the kind of numbers we're talking about. There are several types of Social Security benefits. We're going to cover several. There are a couple we're not going to cover. So our focus is going to be retirement benefits, but we'll also spend time on spousal and survivor benefits because many women end up using both of those, one or both of those. We'll also talk briefly about children's benefits or dependents benefits. What we're not going to cover are disability benefits or Medicare, which is, by the way, a separate claiming decision. Most everyone should file for Medicare at age 65, regardless of when you file for Social Security. And I'm not going to talk about supplemental security income, SSI, which is an needs-based program that complements Social Security. So how do benefits work? First of all, you qualify for Social Security benefits either based on your own work record or the work record of your spouse. The amount that you receive is based on that work record and the age at which you, or in some cases, the age at which your spouse claims. It is lifetime income. It will not cease until you pass away. And one of the major benefits of Social Security is that it has an annual inflation adjustment called a cost of living adjustment, or a COLA, which means that as you age, your benefit will keep up with inflation and your standard of living will not have to be reduced, because the benefit of, like other things like an annuity or a pension, typically is a flat amount that doesn't change and becomes worth less over time. Some of the terminology that we're going to use today, I want you to be comfortable with. I'm going to talk about workers, meaning the person who's going to receive a retirement benefit on their own individual work record. When I talk about spouses and survivors, I'm talking about a person who will receive a benefit based on their partner's work record, their spouse's work record. Now, this is not sexist. This is based on data. I'm going to use he when I'm talking about the worker or the person who's eligible for the larger benefit in a couple, not because I think that's the way it should be, but because in today's world, that is still the most typical case. And I'm going to use she when I talk about the spouse, the survivor, or the worker who is eligible for the smaller benefit within a couple. So, qualifying for benefits. We're going to talk specifics now, starting with retirement benefits, the worker benefits. To qualify for benefits on your own work history, you have to have at least 40 credits, which comes out to 10 years of work with a certain minimum earnings per year to get that. And it must have been a job where you paid into Social Security. You can earn up to 4 credits per year based on the amount earned. $1,410 as of this year will get you 1 credit. So to earn 4 credits, you have to earn 4 times that amount. It does not matter whether you worked throughout the year. The simple dollar amount is the driving factor. Those of you who remember when we talked about quarters, back then, you did have to work in each quarter of the year, but that's no longer the case. And that's why we now talk about credits as opposed to quarters. Spousal benefits, you qualify for a bit differently. Obviously, this is based on the fact that the worker in the couple, your spouse, has filed for benefits. You then would qualify for spousal benefits if you have been married at least 1 year, or you're the parent of the worker's biological child. You are at least age 62, or you're caring for a child who is under age 16. And if it's a divorce situation, you still qualify for spousal benefits if you were married at least 10 years and you are currently unmarried. There's a special little quirk that if you were divorced more than 2 years, if you have been divorced more than 2 years, and your ex is at least 62 or older, In this particular case of divorce more than 2 years ago, it doesn't matter whether your ex has filed yet or not. You would still be able to receive spousal benefits. This is one of those rare instances, I think, where Social Security shows that they understand the real world. That in a divorce situation, your ex-spouse may or may not be communicating with you about whether they are filing for Social Security. In rare instances, maybe they would even be vindictive and feel that they could control your income by not claiming. Well, Social Security doesn't allow them to do that. They don't have to claim in order for you to receive the benefit. Now, how do you qualify for survivor benefits? Obviously, we're talking here about where your spouse is deceased, or in some cases, your ex-spouse is deceased. To qualify for this, you must have been married at least 9 months. Now, this is for those who did not divorce. You must have been married at least 9 months or be the parent of the worker's legal child. There are a few other exceptions, but this is the main one, of being the parent of the worker's legal child. You, the survivor, must be at least age 60. Notice that that's younger than the age at which you can claim other benefits. If you're disabled, you could claim survivor benefits as early as age 50. Or you could claim at any age if you're caring for the deceased child who is younger than 16 or disabled, or someone who is entitled to a child's benefit. You must remain unmarried at age 60. If you were disabled and claimed at 50, then you must have been unmarried still at age 50. But if you get married after age 60 for regular benefits, or age 50 for if you were disabled, marriage after that age is disregarded. For children's benefits, the parent must either be retired or disabled and entitled to Social Security benefits for that circumstance. Or they must be deceased and have paid into Social Security long enough to qualify for survivor benefits. The child itself must be younger than age 18 or between 18 and 19 and still a full-time student in grade 12 or below. I remember the time when I was in college when benefits were still paid to children who were above 18 and going to college. Those rules changed long ago. Just another example of how things do change over time. The final way that a child could receive Social Security benefits based on the parent is if the child is 18 or older with a disability that began before they turned age 22. So that's a summary of qualifying for benefits. Now let's talk about how do you figure out the amount, or how does Social Security figure out the amount? For retirement benefits, they are going to look at a full 35 years of earnings. If you have more than 35 years of earnings under Social Security, they will look at the 35 highest years. If you don't have 35 years, they will use 0 earnings for the years that you did not work or didn't have earnings that were reported to Social Security. There is a limit on the amount of earnings that can count in any given year. For 2020, the highest amount on which you pay into Social Security is almost $140,000. So only that 140 or 137,700, only that would go into the calculation formula for your benefits. In prior years, it might have been 128,000, 120,000, 119,000, as you go back in your earlier working years. Those earlier years of work, though, those earnings are indexed to make them equivalent to today's earnings. And so the fact that you only earned, $10,000 back in 1983 doesn't mean that $10,000 is what goes into the formula. That $10,000 would be adjusted to reflect what would that be in today's wages, and it might be $40-some thousand that would actually go into the formula. That is how they calculate your average indexed monthly earnings, is by taking those adjusted figures for each year and calculating an average per month. Then they break that average monthly earnings into 3 tiers if you had high earnings. The first tier is that you would receive 90% of the first $960 of average monthly earnings. What this means is, for someone who worked at low wages for most of their career, they will see a substantial portion of their earnings replaced by Social Security benefits. But for those of us who have had the good fortune to have higher earning positions, and our average monthly earnings, our average indexed earnings are quite substantially higher than $960. Well, the next portion between 961 and 5,785, in that range, the replacement rate drops down to 32%. So you're still getting a larger Social Security benefit based on those additional earnings, but the proportion of your earnings that are being replaced drops off. And if you have earnings that go above this 5,700 number of average index monthly earnings, the additional will only be replaced at 15%, and only to the extent that it was those covered wages that we just talked about, the $120,000 or $130,000 per year. What this formula calculates is known as your primary insurance amount. We're going to refer to that as PIA, primary insurance amount. It's the amount you would receive if you file at your full retirement age. To be honest, not a whole lot of people file at their full retirement age, because for many of us right now, that's either 66 or it's 66 in 4 months or so forth. We might file as early as 62. We might wait as late as age 70. And so this is just the starting point for knowing exactly how much we'll get. And what is full retirement age? As I said, for folks who have already retired, for the most part, you were full retirement age 66. But for me, for example, I was born in 1956. That means that my full retirement age is 66 plus 2 months for each year that I am younger than age 50, born in year 1954. So I'm 66 in 4 months. If you were born in 1960, though, you have the highest full retirement age of age 67, and that is the highest retirement age regardless of year of birth at this point from 1960 going forward. So it doesn't matter for somebody born in 1960, 1970, 1980. At this point, for everyone in that age range, your full retirement age is 67. If you claim benefits before that full retirement age, your benefits will be reduced. If you claim later, after full retirement age, you get what are called delayed retirement credits that amount to 8% per year. That's a substantial amount, especially in today's low interest rate environment. And those delayed retirement credits accumulate up until you reach age 70 if you delay that long. But at age 70, the increases stop. Therefore, there's almost never any circumstance where you would wait beyond age 70 to claim. All right, I've thrown a lot of facts and figures at you already. Maybe your eyes are glazing over a little bit. So let's take an example to try to make this a little more concrete, a little more real. We've got Alex. Alex was born in 1954. That means that her full retirement age is 66. At 66, meaning at her full retirement age, her primary insurance amount is $1,000 a month. Yes, I picked easy numbers here. What happens if she retires younger or older? Well, the earliest she could take Social Security benefits is age 62. And at that age, she would receive a reduced benefit of $750. If she delayed and did not claim until she reached age 70, it would increase up to $1,320. And I just want to point out that the benefit of this higher amount at age 70, and conversely the harm of the lower amount at age 62, is that your cost of living increases each year going forward are based on the benefit amount you began with. So if you started out with a $750 benefit, you're going to be getting a cost of living increase each year that's the same percent, but a much lower dollar amount than the person who waited until they're age 70 and is getting that cost of living increase calculated on that much higher monthly benefit. That was retirement benefits. Now let's talk about spousal benefits. The maximum spousal benefit is very simple, 50% of the worker's primary insurance amount. And it is not affected by the age at which the worker filed. So if your husband retires and claims Social Security at 62, 66, 68, 70, for your spousal benefit, it makes no difference. It is still calculated as 50% of his primary insurance amount, the amount that he would have gotten if he had retired at full retirement age or claimed benefits at full retirement age. Now, if you are also eligible for a worker benefit, so you're eligible for worker benefit on your own work, you're eligible for a spousal benefit based on your husband's working, you will get the larger of the two. You won't get both. You will get the larger of the two. Now, the thing that will affect the amount of your spousal benefit is if you claim before you reach full retirement age. Then it's reduced based on your age at the time you start receiving the spousal benefits, but not based on the age of your spouse when they started receiving their worker benefits. There is no increase in spousal benefits once you reach full retirement age. So if spousal benefits are what you're going to receive, they are larger than the worker benefit that you earned yourself, there's no benefit to waiting past your full retirement age before you claim spousal benefits. The dollar amount will not increase. And if we have a divorce situation, your benefits on your ex-spouse will end if you remarry. And so even though you began receiving spousal benefits on your ex, those can stop if you remarry to a different person. Let's look at another example here. We have Jack and Julie. Jack filed for benefits. His primary insurance amount was $2,000. Like I said, doesn't matter how much he actually got. All that matters is what was his primary insurance amount. Julie's maximum spousal benefit, therefore, is exactly half, $1,000. Well, she filed at her own full retirement age. Therefore, she's entitled to that full $1,000. But she was also entitled to benefits based on her own limited work history that added up to $200 a month. What will she actually get? She will receive the $1,000 because that is the spousal benefit is larger than her own worker benefit. So she simply gets the spousal benefit, the full $1,000. Remember that if she did claim before her full retirement age, that could be reduced. And it could be reduced similarly to the way a worker benefit is reduced. So if she claimed at age 62, she might receive somewhere in the neighborhood of $720 instead of the full $1,000. Survivor benefits work completely different. So we have to kind of relearn our rules here. For survivor benefits, the maximum amount that you can receive if your husband has predeceased you is the amount he was receiving at death if he was already receiving Social Security benefits, or the amount that he was eligible for if he had not yet claimed. So you can see right off the bat here that the age at which your spouse files for benefits may not affect your spousal benefits, but if you're the one who lives the longest, it will impact your survivor benefits because you can only get whatever your deceased spouse was actually receiving or what they were entitled to at the time they passed away. So if your spouse files anytime before they reach age 70, in effect, they are reducing the spousal benefit, the survivor benefit that you would be able to receive. The amount that you actually receive can also be reduced if you file for survivor benefits before you reach full retirement age. But in this case, it's a different full retirement age, known as survivor full retirement age, it can be a few months earlier than your regular full retirement age. So with survivor benefits, how do you get the largest benefit possible? You wait until you have reached survivor full retirement age before you take the survivor benefit. And the amount that you can get will also be determined by the amount that your spouse received and whether they had delayed and received larger benefits or not. But please note this last bullet. There is no increase if you wait past your survivor's full retirement age. So just as with spousal benefits, there's no point in waiting beyond full retirement age before you claim spousal benefits. They won't increase beyond that point. That is the same with survivor benefits. They will not increase beyond the age of your survivor full retirement age. So there's never any point in waiting until age 68 or 69 or 70 to claim survivor benefits. Here's an example, again, to kind of make this a little more concrete, a little more easy to wrap your heads around. We've got Walter and Winnie. Walter filed for benefits at age 62. Although his primary insurance amount was $2,000, what he actually received was $1,500, that reduction for claiming benefits at age 62. But he did get cost of living increases, and so by the time he passed away at age 68, he was receiving $1,750. Winnie was 67 when he died. That means that she was past her survivor full retirement age. So in that case, she will receive the full $1,750 that Walter was receiving at the time of death, and she will continue to get cost of living increases on that amount. But what if Walter had delayed? What if he had waited until age 70 to file for his benefits? Well, as we said, his primary insurance amount was $2,000. There's a table we can look at that would tell us that means at age 70, his benefit would have increased to $2,640. If he lived another year and then passed away, again, he would have had some cost of living increase, so $2,719 perhaps. And Winnie, in that case, would receive $2,719 a month compared to the $1,750 in our previous example where Walter filed at age 62. And again, her future cost of living adjustments will be calculated on this larger amount since that's what she's receiving. Something that is fairly unique to survivors is that when they file for benefits with Social Security, they can file what's known as a restricted application. What that means is that they can restrict their application to only one benefit, even though they're eligible for two different ones. Normally with Social Security, you file for benefits, they say, oh, you're eligible for both spousal and worker benefits. Spousal is bigger, that's what you get. Or if the reverse is true, you file, so they look at spousal benefits and worker benefits, your worker benefit is larger, that's what you get, end of story. But with survivors, you can file for just one benefit at a time. You can file for just your worker benefit on your own history, or you can file for survivor, and then you can choose to switch later on. And choosing the right benefit to claim first can make a huge difference in your lifetime income. Here's an example. When he was 62 and Walter died, kind of going back to our first example, she filed a restricted application for her own worker benefit of $1,100. And at age 66, which is her survivor full retirement age, she then switches to the survivor benefit. She will receive at that time whatever Walter was receiving. If he'd filed early, it would be $1,750. If he had filed later, it could be as much as $2,700 a month. Now, if she filed for this survivor benefit before she reached her survivor full retirement age, the dollar amount would be reduced. And so this is where there's some strategy that gets involved as far as when is the right time to claim which benefit for when. And I'm going to talk about what the research has shown as we get toward the end of the program. Now, just briefly about the family maximum. When you have a situation where there's not just a spouse, but there are also dependents, typically children, who could receive benefits on the same worker's history. The maximum combined benefit is somewhere between 150 and 188% of the primary insurance amount. And this has to be spread across all the family members who would be receiving benefits on the deceased's work record. So let's say we have a young father who passes away in his 40s, has a surviving spouse and 3 children under the age of 16. The spouse is going to get a spousal benefit. The children are eligible for dependent benefits, but the maximum across all 4 of those individuals can only be somewhere between 150 and 188% of what he was eligible for. Now, one exception, let's say there was a divorced spouse in there as well. Payments to a divorced spouse would not impact payments to a current spouse and any dependent children in that household. If the worker is retired, not deceased, and the family maximum in that case would apply to the spouse and the children, but not to the worker's own benefit. The worker's own benefit is never reduced because of a family maximum, but the other beneficiaries are reduced proportionately. All right, take a deep breath. You got the hard stuff under your belt now, but we need to talk about a few special rules, a few special situations. With divorce and Social Security, in order to qualify for either a spousal or a survivor benefit, you must have been married for 10 years or more. I actually talked with a woman briefly today and told her about the program I was doing tonight because she told me that she was getting divorced and she needed to learn more about managing her finances. And the first question I asked her was, how long have you been married? Because I told her if she had said 9 years and 6 months, I would be telling her, put this divorce on hold for 6 months because that 10-year mark is critical. If your ex remarries, it will have no impact on your ability to claim spousal or survivor benefits or the amount of those benefits. This is another place where I think Social Security actually shows some understanding of the real world. They have not put anyone in the position where an ex has control over what you might get. You know, there's no way for somebody to get back at you through Social Security. However, your spousal benefits will end if you remarry, and your survivor benefits will end if you remarry before you reach age 60, when you can first claim survivor benefits. Now, another thing that's unique about divorce situations is even if your ex, okay, let's say your ex starts taking Social Security, but then suspends, meaning stops, requests for the payments to stop so he can delay and take them again later at a higher amount. In a regular married couple, that would mean that the spousal benefit would end as well. But in divorce situations, if you're receiving a spousal benefit based on your ex and he suspends, your benefits will continue. They will not be affected. And remember, I mentioned earlier a special rule if you've been divorced at least 2 years. That means that you don't have to wait until your ex files for benefits before you can get a spousal benefit. All that has to happen is he must have reached age 62 or older, and then you could file for a spousal benefit if you've been divorced at least 2 years. Going back to that, for anyone else, the spouse or the ex-spouse must actually be receiving benefits in order for you to receive spousal benefits. A couple more things about divorce and Social Security. If you qualify based on age, both you and your spouse could file that restricted application that I mentioned, that normally we think of with a survivor situation. But in a divorced couple, each of you could actually file for spousal benefits on the other one without either of you having claimed your own worker benefits. In this case, divorced couples actually have a unique planning opportunity here. This is kind of a loophole, to be honest, that was closed for married couples for the most part, but was not closed for divorced individuals. But make note, you have to be age eligible for this. You must have been born on or before January 1st of 1954, and you must wait until at least full retirement age before claiming. Social Security now has a rule called deemed filing. This is something that changed a few years ago and put an end to some of the claiming strategies that married couples had used up to that point to maximize the amount that they received. You are deemed to be filing for any and all benefits for which you qualify. And the example I already gave you earlier is if you were eligible for both a worker benefit on your own record and you're eligible for a spousal benefit. You won't get both. They will look at which one is larger, and that's what you'll get, but you don't get to pick which benefit you're applying for. There are exceptions, though, to the deemed filing rule. Restricted applications are allowed, as I already mentioned, for survivors. They are allowed if you're a spouse who's caring for a child under age 16 or disabled, or a spouse who is eligible also for disability benefits themselves, or if you were born on or before the 1st of January 1954 and you reached full retirement age before filing. That means that right now you would have to be 66 already or older in order to be eligible for that. But in all other situations, you will be deemed to be filing for any and all benefits for which you are eligible. There are also some special rules about working while receiving benefits if you are younger than full retirement age. So if you're younger than full retirement age, your Social Security benefit is going to be reduced by $1 for every $2 that you earn over $18,240. Now that's the number for 2020. It goes up incrementally with inflation each year. What this means is, let's say that you're working and you're earning, let's say you're earning $60,000 a year. Just trying to make this kind of an easy math question here. That means that you're earning, in round figures, $40,000 over this $18,000 limit. $40,000. The benefit is going to be reduced by $1 for every $2 that I'm over. That means that my Social Security benefits would be reduced for this year by $20,000. If I'm receiving Social Security benefits of less than $20,000, I will receive no benefits this year because I'm younger than full retirement age and I continued working and I'm earning quite a bit more than the amount under which they wouldn't penalize me. In the year you reach full retirement age, the rules change. In that year, the reduction is only $1 for every $3 over a much larger amount. And this limit only applies in the months before you reach full retirement age. In the month you reach full retirement age and beyond, how much you earn has no impact on Social Security. There will be no reductions once you have reached full retirement age. But here's the good news. Those benefits that were reduced, technically, you didn't fully lose them because you're going to get at least most of it back down the road. Here's why. Let's say that you claimed Social Security at 62. Full retirement age is 66. So you claimed 4 years early. That's 48 months, but you kept working. And you ended up only getting benefits for 24 of those months. When you reach full retirement age, Social Security is going to recalculate your benefit. And your original benefit was calculated based on the fact that you were 48 months younger than full retirement age. they're going to recalculate it as if you filed when you were only 24 months younger than full retirement age, because those are all the months that you got benefits for. And so this is a way that they sort of make it up to you that you filed, you got a reduced benefit, but you didn't get the full value out of it. And so this recalculation takes that into consideration. And then if you continue to work after full retirement age, you might continue to see your benefit continue to increase because your 35 years, maybe you are replacing low income years with higher income years, or you're replacing zero income years with actual income. So you might even see additional increases after full retirement age if you continue to work. There is a limited opportunity to change your mind about taking Social Security benefits. This is the first way of doing it, and it's called a withdrawal. It's a redo. If you filed for Social Security within the past 12 months and you change your mind, you could repay all the benefits that you received, just the benefits. You don't have to pay any interest, and you get a restart. You can decide later on when you want to start benefits again, and they will be calculated and paid as if you had never filed at all. Like I said, this only applies if you filed within the last 12 months. Now, if you are filing after full retirement age, there are a couple of things that you need to be aware of that, that you can do then. The first thing is that when you file, Social Security may ask you if you would like to get retroactive benefits. It can be for as much as 6 months or however many months you are beyond full retirement age. And you may think, oh man, this sounds like a great thing. You know, I'm going to get this lump sum check equal to 6 months worth of Social Security benefits. Well, yes, but the benefit is going to be calculated based on that younger age. So your monthly benefit is going to be permanently reduced if you agree to take these retroactive benefits. The other thing that changes when you file at or after full retirement age is, in addition to that opportunity to withdraw that I just talked about, which is so limited because you can only do it for 12 months after your original application. After you reach full retirement age, let's say you decide, I wish I hadn't filed. I wish I'd waited. Or your spouse wishes he hadn't filed. He wishes he had waited. Well, you may not be able to withdraw. Let's say it's been 3 years since you filed, but you can suspend, which means that you don't pay back anything you've already received, but you stop receiving payments, and then you get to restart later. Any increases that you would be due because of that delay from the date of your suspension on up until age 70, you'll get those delayed retirement credits. And the thing you have to remember is that if you suspend, anybody else who's getting benefits based on your payment, maybe it's a spousal benefit, maybe it's a payment to a dependent, those are also going to stop. 2 exceptions. If you had already filed and suspended way back in April of 2016 or earlier, then you're grandfathered in, or in that divorce situation that I mentioned a couple of minutes ago. But in all other situations, if someone suspends, anyone receiving benefits on that will be suspended as well. This is not something that is actually about Social Security benefits, but it's about how our income tax system treats Social Security benefits. It is possible for as much as 85% of your benefits to be taxable income. And it depends on how much other income you have. So we've got this concept called combined income. And for a single person, the amounts that count are the lower hurdle is $25,000 of combined income. The higher hurdle is $34,000. If your combined income is under $25,000, then there will be no tax on your Social Security benefits. But if you're between $25,000 and $34,000, You'll pay tax on some of your Social Security benefits, perhaps as much as half of your benefits would be taxable. And above $34,000, you'll pay tax on somewhere between half of your Social Security benefits and 85%. Make note here, though, that you'll always have part of your Social Security benefits that are not taxable income. And when we talk briefly about some of the more sophisticated calculations about claiming strategies, the fact that some Social Security is never taxable income is a factor in some of those strategies. Now, combined income. This is not a concept you're probably familiar with, but in the footnote, you'll see this is your adjusted gross income, but you have to also add to that any non-taxable interest plus half of your Social Security benefits if they weren't already included in that adjusted gross income. So you can see that, let's say you're getting $12,000 of Social Security benefits each year. That means that $6,000 of that will count toward combined income, plus any interest you're receiving, any dividends you're receiving, any earnings that you have. It's not very difficult to get over these limits. And the reason is that these dollar amounts were set literally decades ago, and they do not change. They have not been indexed for inflation. And so many more of us nowadays end up paying income tax on our Social Security benefits than we did when these rules were first put into place. And just a mention here about pensions where you may have worked in jobs that were not covered by Social Security. Now, typically here we're talking about government jobs, especially here in Illinois, because Illinois is one of the states that decided that for the most part, government workers here would be paying into state or local pension systems rather than rather than into Social Security. So if you were a state of Illinois worker, you may well have paid into a state of Illinois pension and not paid into Social Security. How does that affect your Social Security benefit? Could affect it in two ways. First is the windfall elimination provision. And this affects the calculation of your own worker benefit for Social Security. The good news is that you will always receive something if you have other work that qualifies you for Social Security. But there will be a reduction unless you have 30 years of substantial earnings under Social Security. And there is a chart that shows you what are substantial earnings for each year going back 50 years. The other way that receiving a pension from work where you did not pay into Social Security could affect your Social Security benefits is through the government pension offset. This applies when, let's say you're the one who worked in a government position, you never worked in Social Security, you were counting on getting a spousal benefit or a survivor benefit from your spouse who worked in Social Security covered jobs. Well, government pension offset says that your Social Security, that Social Security may reduce your Social Security benefit based on your pension amount. And the reduction would be $2 in reduction to your Social Security benefit for every $3 of pension. And in this case, it could mean that you receive no Social Security. In the future, I probably should add an example in here. So let me just try to do a quick one for you. Let's say that you're receiving a government pension of $1,000 a month. That means that any spousal or survivor Social Security benefit that you might receive would be reduced by $2 of every $3 of pension. Two-thirds of 1,000 is $667. That means that unless you were expecting to get more than $667 per month from Social Security, you'll get nothing. If you were expecting to get $1,000 a month from Social Security, you'll get the remaining $333. So the government pension offset rule is very important to understand. Windfall elimination provision is also very important, but it is less onerous than government pension offset. However, in fairness, I have to say this. These rules were put into place to really level the playing field between people who worked in government jobs and under regular Social Security rules looked like low-income workers who got 90% of their earnings under Social Security replaced by their Social Security benefit, when in reality, that wasn't the case. They may have had pretty good jobs where they didn't pay into Social Security, and the formula couldn't accommodate that. That's why these rules were put into place, was really to make the system more fair. It won't feel good to those of you who have government pensions, but in my opinion, it actually was a fair thing when they implemented these. All right. You've got all the tedious stuff in hand. What are the guidelines? What does the research say about what strategies might work best in your situation? Let's go over some of these. One thing to keep in mind is the real risk that most of us face is living a long life. It's called longevity risk. You know, I have a great uncle who lived to be 107. It would be pretty easy to run out of money if you live to be 95 or 100 or 105. And delaying your Social Security benefit and getting that larger benefit, you can view that as a type of longevity insurance. Locking in that larger benefit with its cost of living adjustment to look after you in the event that you do live a very long time. Now, who should be most concerned about getting the largest benefit possible in this way from Social Security? If Social Security is going to be your main source of income, this could be really important for you. Individuals who are quite healthy and or who have a long life expectancy, like, you know, in my family, people really do live a long time. So this is something that I should pay attention to. And just to remind you that if you're married or divorced, so that we have two people's life expectancies to think about, there's a very high chance that one of you is going to live well into your 90s and therefore need income to help them during that period of longevity. So thinking about longevity insurance is often more important for a married couple, and in particular for the higher income earning spouse, than for a single individual. If after thinking about this concept of longevity insurance, you know, delaying to get those extra delayed retirement credits, larger benefit, larger cost of living adjustment to help look after you if you do live a long time. If you've already claimed Social Security and now based on this, you're thinking, maybe that was a mistake. Well, if you've already reached full retirement age, you can suspend. If you filed within the last 12 months, you can withdraw. Those are the two things available to you if you already claimed and decide that that was not the best strategy for you. For married couples, there is sort of a general strategy for maximizing Social Security benefits between the two, and it works like this. The worker who is entitled to the larger benefit delays. So typically this is going to be the male, and he might decide to delay all the way until age 70 if that's financially possible. The lower earning spouse is going to file earlier. Now, the exact timing would depend on whether she's still working, you know, other things in here, but in general, she's going to file earlier, anywhere between 62 and her full retirement age. If the higher earner is old enough, meaning if they were born on or before the 1st of January 54 and they reached full retirement age before filing, and this would be the last year anybody can do that, they could then file a restricted application for a spousal benefit based on the lower spouse's earnings. Most of us are not going to be able to do this. We're going to have just that lower earning spouse filing, end of story, until the larger earning spouse delays and claims later. But if you're eligible based on age here, you could file that restricted application this year to get a spousal benefit on the lower spouse's benefits, assuming that they have already filed. The question, though, is going to arise for a lot of folks. Okay, this all sounds well and good, delaying and getting a larger benefit, but I need the money. I need the money to live on. Well, it's worth investigating options. It may be worth taking a step back and saying, yeah, I'd always thought I was going to retire at 65, but I could think about holding off until 67 or 68. There's also research that indicates that it could be a good idea to take voluntary distributions from your tax-deferred retirement accounts like 401ks and 403bs, if that enables you to let that Social Security benefit delay and increase. And I've given you the titles of two of these things here, and I have these links posted on my website where you can find them as well. The first one is written fairly recently, why 401k and Social Security coordination is critically important. This was written fairly recently. It was written for financial planners, so it's a bit heavy. But if you were interested in attending tonight, I think you're probably up to it. You may want to read that. The second one is older. It was actually written when before Social Security rules had changed a few years ago, but the concepts are still pretty valid. It's a white paper. It's long, so you may just want to read the abstract to get the general idea. But they both make the case that, at least in some situations, drawing down those retirement accounts and letting your Social Security benefit grow can be a very worthwhile strategy, not only because your Social Security benefit increases by 8% a year after you reach full retirement age, and that's huge in an environment where interest rates now are basically zero, but also because of that 15% of your annual Social Security benefit will never be taxed. That 15% keeps getting bigger and bigger as your Social Security benefit grows, making the tax savings better. And by taking voluntary early distributions from these tax-deferred accounts, you'll be reducing your required minimum distributions later on, and you could have an overall reduction in taxes there. So doesn't work in everybody's favor, but worth investigating. Now, what about survivor situations? Your spouse is deceased. You're the survivor. What benefit should you claim first? The approach here is to compare your own, assuming that you qualified for a Social Security benefit yourself, to compare your primary insurance amount to the primary insurance amount of the deceased. So let's just go right into this. If your primary insurance amount is very small compared to the deceased's, and in the research, the exact ratio was 17%, that's an indication that you should claim the survivor benefit pretty early, sometimes as early as age 60, almost never any later than 63, not waiting until your survivor full retirement age. Obviously, if you didn't claim your survivor benefit until age 62 or later, you'd want to file for your own worker benefit first, just for those months to get something while you're perhaps waiting until age 63 to claim the survivor benefit. What if your earnings were still less than the deceased's, but respectable in comparison? If they're still less than 2/3 of the deceased's benefit amount, you would start by claiming your own worker benefit at age 62, and then switch to the survivor benefit by full retirement age. This is going to, according to the research, give you the greatest dollar amount. It doesn't necessarily give you the greatest longevity insurance, but it's expected to give you the greatest dollar amount overall. If you earned an amount comparable over your work history to your deceased spouses, or you earned even more, in this situation, you would want to start by claiming the survivor benefits and claiming them right away at age 60 when you're eligible, and then waiting to switch to your worker benefits, perhaps all the way until age 70. Now, If you earned a lot more than the deceased, it might work out that you should switch a little earlier at age 68 or 69. But nonetheless, the general strategy, if you had comparable earnings or more earnings than the deceased's, starting with their survivor benefit and then switching to your own worker benefit after you have let it grow and increase with those delayed retirement credits. So what might you want to do after having attended tonight's program? If you haven't already, go to socialsecurity.gov, ssa.gov will get you there too. Go to the My Account section and get your benefits estimate. Verify that all your earnings are recorded accurately. If you have a government pension, so that you're going to be subject to the windfall elimination provision or the government pension offset, you'll need to use special calculators to get an accurate estimate of your benefit. Maybe you discover that you didn't change your name on your Social Security records after you got divorced or after you got married or so forth. That's something you want to get straightened out now, not waiting until you're filing for benefits. And I told you at the beginning that Social Security benefits are complicated. The rules are complicated. And the claiming strategies, they're not as complicated as they used to be, but they're still difficult to figure out just eyeballing things, or even if you're a good Excel spreadsheet person. So I would actually recommend, I guess this is one place where I am giving advice, but I'm not telling you what you should do financially. I'm just telling you how to get more information. I would suggest that you try one or more of the commercial calculators, the commercial software that's out there designed to help you determine your best claiming strategy. These are no longer free, but I think they are money well spent. MaximizeMySocialSecurity.com is a well-respected site. Kotlikoff is the developer. He is a Nobel Prize winner. It'll cost you $40 a year to use it. Probably 1 year is all you'll need. After you figure out what your strategy is, you'll be pretty much done. This is the one that I found to be a little more user-friendly, but SocialSecuritySolutions.com, also highly regarded academic people behind this. The fees range depending on exactly how much services you want, starting about $20. If you're not sure you're really ready to claim yet, then try some of the, you can just do a Google search for some of the free calculators, but do try more than one. And the reason I'm recommending these two commercial software is because some of the free calculators don't accommodate every circumstance. If you have dependent children who are going to be receiving benefits, if it's a divorce situation, if it's a government pension situation, anything like that makes your claiming more complex, and you need a calculator that takes into consideration all of those factors so that you can get the most accurate results from it. And for any of the other things I referred to, like for the windfall elimination provision or the government pension offset, Social Security has excellent readable information on all these things. And you can find links to all those resources. If you go to the tab on my website, the website is simply KarenChanFinancialEd.com. Go to the resources tab and scroll down to click on Social Security. That will give you links to all of the things that I've talked about tonight, those two research articles about why you might want to claim, take money out of your retirement accounts before claiming Social Security, anything like that that I've talked about tonight, you'll find the links there. So I've inundated you with quite a bit of information tonight. So Patty, I gathered that there weren't any, wait a minute, I have no idea what she just said kinds of questions, but I'm guessing we have other kinds of questions.
I am here. Can you hear me?
Yes.
Wonderful. No, I'm sorry, I can't tell you that because we certainly do have questions, but I don't think it's for, it's not for the lack of covering a wide canvas of possibilities. And I think all of your examples were really, really detailed. So there was no shortage of examples there. But we do have like 4 questions for right now. Want to take a breath or a sip of water and then we can go?
No, let's just dive in.
Don't want to keep you up too fast. Okay. So I have one question from a patron. So as an ex-spouse, if I take my ex-husband's Social Security, will there be a benefit to me to waiting to age 70, or will the amount I receive be the same I receive if I take it at 70?
Okay, this is a divorce situation, right?
Correct.
Okay, so as a divorced person, your situation is a little unique, and pardon me, but I'm going to actually go back to the slide where we talked about this. Okay. For most people, when you file, you don't get to pick and choose what benefits you're applying for. Social Security will say, so for a married person, Social Security would say, oh, you're eligible for a worker benefit and a spousal benefit. You don't get to pick. We're just going to give you whichever one is bigger. Done. And once you've taken that benefit, you're locked in as far as that amount. But if you were born on or before the 1st of January 54, and if you reached full retirement age before you filed, you can file a restricted application. So in that case, you could file for a spousal benefit on your ex and let your worker benefit continue to grow. And actually for a married couple, if you're age eligible, if you were born on or before the 1st of January 54, you could also do this. But if you don't qualify based on age, you will be deemed to file for both benefits. And in that case, it really depends on whether the spousal benefit is larger or your own worker benefit is larger. If the spousal benefit is larger by a little, doesn't have to be hugely larger, but let's say 20% or so, spousal benefits don't increase beyond full retirement age. So you should go ahead and file at full retirement age if you didn't file before. No point in delay. It will not increase. But if your worker benefit is the larger, and that's what you're going to be getting benefits on, then you might want to think about delaying because it will increase up to age 70. Now, the person who asked the question, if I confused you more rather than clarifying, feel free to post a follow-up. But those are how the rules work. So it really depends on whether the spousal benefit is larger or your worker benefit is larger. If the spousal is, no point in delaying beyond full retirement age. If the worker benefit is larger, then there would be an increase if you delay up until age 70. And then the gray area there is, let's say that the spousal benefit is only 10% more than your worker benefit or 20% more. Well, that's where you're going to need the commercial calculator to help you figure out, does that mean that going ahead and claiming the spousal benefit is the better thing, or should I wait until 70 and then I won't get a spousal benefit, but my worker benefit will have increased? That's where the commercial calculator would come in handy. What's next? Patty, you may be muted. Patty? Okay, I can't hear Patty, so I'm going to try to open up the Q&A section here. Okay. All right. The question, it looks like the next question is the maximum benefit I can get as an ex-spouse is $1,500? No, that's just the example that I used based on the amount that that your ex was receiving. It's all dependent on the amount that your ex was receiving. If $3,000 is what your ex was receiving, then yes, 1,500, the largest spousal amount. Those would be about the maximums for this year, but those maximums increase slightly each year. Is there any way to increase benefits for a single woman? No dependents. Two ways: delaying, working additional years if you don't already have a full 35-year work history, and if the additional years you work, the income would be larger and replace lower years in that 35-year calculation. Those would be the two ways potentially to increase your benefit. Looks like one more here. Okay. All right. That's all I see there, but some people may have posted under chat, so let me go there. Okay. The question is, if Joe predeceased his ex-wife Jill, they were married for 25 years, and Jill is no longer living in the US, can she make a claim when she turns 62? Jill became a US citizen when they were married, but relocated to her country of origin after divorce and hasn't contributed to Social Security since leaving. Joe is the high earner. Does she need to be US resident to receive benefits? I would have to look this up. My gut says, well, I'm not going to listen to my gut here. That doesn't help you when you're dealing with taxes and with rules for Social Security benefits. I would have to look this up. And so if this is someone that would like me to follow up with them by email, maybe there's a way for you to send a private chat to me, or on my website. Hi, Patty. Sorry, I lost. I think we lost your.
I'm glad you continued. No, I got bumped out, and I tried in various ways. That was a question that came to me by a patron that could not attend tonight. So if you could consider an answer, that's why it was submitted through my chat.
Okay.
If you could please consider an answer for that. And then there was a two-part to that question. Neither one are approaching Social Security at this point. They're still in their mid-40s. But it was about that the individual that is no longer in the States was a citizen. She had earned Social Security for her jobs while she was here, but it's nothing in comparison to what her spouse had earned. So whether or not she returns to the States or not, is she eligible to apply for benefits? And does she have to, say he turns 63 and he doesn't apply, does she have to wait for him to do it? Or can she go ahead at 62?
Yeah. So if you could do this for me, Patty, because with the screens I have open right now, I don't have a way to cut and paste and save that question. If you could email it to me after the fact.
Happy to.
That'd be great.
Yeah, glad to. And so sorry that I got bumped out. And thank you for carrying on. I do have, did you happen to get this other question? What is the maximum amount anyone can make if they wait till age 70? And if it's more than $3,000, quote, my ex-spouse, unquote, would I be able to get half his age 70 amount or just what his amount is at age 67?
Okay, so let's take the first part of that first, which is the maximums that I gave you. And again, I'm going to go back to those slides. Okay, so yes, for this year, the maximum benefit what I said was $3,000, but remember, this was for someone claiming at age 65. So if they waited until age 70, that 3,000 would become approximately 4,000, maybe 4,100. Okay. Just with the delayed retirement credits. So 3,000 is the maximum at age 65. The maximum increases as you get those delayed retirement credits for each year. So let's say like around $4,000, $4,100. Then as a spouse, Your spousal benefit is based on the primary insurance amount, not the amount that they got when they delayed claiming. So your spousal benefit would still be limited maximum to about $1,500, but your survivor benefit, you would receive 100% of what the deceased was receiving when they passed away. So your survivor benefit would be hugely impacted if they delayed and did not claim at full retirement age, but instead delayed to age 68 or 70 or 70. That was the question, right?
Yes, I believe so. I'm just going to leave it for a moment to make sure that that's answer to completion for the patron. But I think what you said made clear sense to me, but it's the patron's details. I just want to make sure.
Sure.
And the only other things that I have put into the chat are just future programs. So
okay.
The patron asked if she can, the patron can either email me or email Karen directly with that question for follow-up.
Yes.
Okay.
And I don't know if I posted my email anywhere. So the easiest thing to do is on your handout, that on the last slide, it gives you my website. And if you go to the Contact Karen tab on the website, you can send me a question directly there.
Okay. Well, Karen, we're approaching about 10 to 8, and I think all of our questions have been addressed between here and I think our YouTube channel. We were able to welcome 5 additional people.
That's so cool.
It is so cool, and it is still going to be up there, but we didn't have any questions coming through there. So you have run the gamut completely, and wow, that was just a wealth of information on your slides. I can't thank you enough for preparing such a quality presentation.
Well, it's an important topic. I appreciate everybody who took the time tonight to come and join. Hope it was helpful, and hope it helps you in the long run.
Moving forward into 2021, I do want to make mention we have we're hoping for the very best in our first quarter of next year. Money Smart Week takes place usually the very end of April, the beginning of, or the very end of March, beginning of April. And the best willing, we hope that we can invite Karen back for doing another financial program with us. It would be great to work with you again.
Look forward to it.
I'm going to do one more quick scan here. Chat. Just some thank yous from patrons to you, Karen.
Okay. Thank you.
On behalf
Appreciate
of
that.
the Schaumburg Library, we really appreciate you being here tonight. And everyone, take good care. Be well. I put the library's hours on the chat, as well as my contact information. So please do come and visit us when you can. And in keeping social distance, if there's something we can help you with remotely, let us know.
Right.
Thanks again. Have a good night.
Thanks, Patty.